Thank you for joining us. The following presentation is from a webinar titled Fraud, Not If, But When, originally produced on February 20th, 2014. The presenters are Janice Snyder and David Hammerberg with McKonly Asbury, along with special guest Joseph Krzywicki with PNC Bank. Enjoy the presentation and visit us online at www.macpas.com for information about our future events and upcoming webinars.
Thank you, Reed. It's a pleasure to be here today. As mentioned, I'm a partner with McKonly Asbury, and I have 15 years experience, but my experience is with financial statement audits and employee benefit plan audits. I have the honor today of having with me Joe Krzywicki, as Reed mentioned, as well as Dave Hammerberg, and they are our fraud experts today. And I'm excited to hear their perspectives, as Joe brings extensive perspective on external frauds, and Dave brings us some knowledge of internal frauds. So Joe, can you introduce yourself?
Thank you, Janice, and thanks for having me here today. My name is Joe Krzywicki, and I've been in banking and treasury management for about 20 years. And really, treasury management is the study of working capital and cash flow, which involves, any payment that a business might receive or make. So I've been doing that for about 20 years. I'm a certified treasury professional, have some private sector experience in the higher education field, and really the group I manage focuses on all industry segments and represents all types of larger and more complex businesses.
Great, thank you. That's very helpful. And I know we have Dave Hammerberg here. He's our certified fraud examiner. So Dave, can you introduce yourself to our audience?
Yes, Janice. My name is Dave Hammerberg. I've been with McKonly Asbury for about 13 years, and in those 13 years I have been doing quite a few fraud investigations. My background is in accounting and IT. I'm a certified fraud examiner, as well as a CPA. And as Janice said earlier, my focus is mainly on internal fraud.
Okay, great. I'm really excited to hear what both of you have to say today about fraud. So real briefly, let me tell you about our agenda for today. We're basically going to have a panel discussion, and we're first going to talk about who cares about fraud and give you some statistics and some reasons of why you should be concerned. The different types of fraud, as we mentioned, internal fraud and external fraud cases, exposed real fraud cases, as I get to interview Joe and Dave today and hear some of their real stories, and get the lessons learned from those stories, as well as how we'll be able to prevent some of these things from occurring either personally or within your organizations. So let's get started. All right, Joe, the first thing I'd like to know is, why should I care about fraud? I mean, if I work for an organization, I've never been affected by fraud and it's never happened to me personally, I want to know, why should our audience be concerned?
That's a great question, Janice. Like the title says, it's not if, but when. And let me start with a quote from the Association for Financial Professionals. And that's really a group that studies working capital and works with treasury groups across the country. And their quote is, "The vulnerability of all payment methods to fraud from external and internal sources demands a range of fraud-fighting tools and the vigilance of those financial and treasury professionals responsible for protecting the assets of their organization." When you look at the scope of fraud, and you can look at the headlines that are on the slide, and even beyond that, more recently, look at what's going on with Target stores and the compromise and the impact of those occurrences on the credibility and the viability of a business. You can really start to see the impact. And to put it in perspective, fraud in both check fraud and cybercrime form is about $100 billion a year industry. And to put that into terms of occurrences, that's about 5.5 billion attacks on computers and organizations every year. And the targets of those attacks have changed. It's large companies, it's small organizations, it's not-for-profits, and even internally, it's not just the CFO or controller who needs to be aware. It's every employee in that organization being vigilant with how they handle the internal security protocols and the internet systems that have to protect the organization.
Joe, I see a lot of recent headlines here of different organizations that have been significantly impacted by fraud. And as you said, there's potentially 100 billion reasons out there why individuals should be concerned about fraud. So I'd like to know how many businesses are impacted annually by internal or external fraud, and what is the typical loss?
That's another good question. And I'll quote the AFP studies a lot because every year they do a study to map out not just the instances of fraud, but also the impacts and the trending as well. So the most recent study that came out showed that 61% of businesses were attacked. Some of those resulting in actual fraud, some were prevented or mitigated. So when you look at the scope of that $100 billion is a big number, and certainly the 5.5 billion attacks is as well. But 6 out of 10 businesses, and those listeners on the line, will be attacked in some form this year. So it really is something that everybody needs to be aware of and needs to take some measures. And when you talk about what the actual losses are, a typical loss, and typical, certainly there are much larger ones and some smaller ones, but when you look in the range of $20,000 is the typical loss to any business. And that just encompasses the financial piece. When you look at the other things that go along with that, fraud and liability are not a clear-cut and well-defined occurrence. So there's always a dispute or a discussion to figure out who is liable. So there's time lost in that process. There's certainly a lot of research that goes into discovering what happened and documenting that. And while this is all happening, there's a disruption to your customers. There's an impact to your reputation. And at the end of the day, this could impact the financial viability and the competitive position of an organization.
Joe, that's a great slide. You mentioned the $20,300 there, and I find with the internal investigations I've been doing over the years that a lot of the frauds are between $15,000 and $25,000, and at that rate, it's real tricky to come up with that number and not spend another $20,000 on the investigation. So, if you put those preventive tools in place to begin with, instead of a $20,000 loss turning into $40,000 because you have to investigate it, we need to put the tools in place to begin with.
So I know we've mentioned there are two types of fraud, internal and external fraud, but I just wanted to pause for a moment because I see a lot of internal fraud, and that's fraud within your organization where you may have an employee stealing from you or someone that you trust or someone higher up in the organization that has the ability to override certain controls. But Joe's also talking here about external fraud, where someone outside the organization is accessing your checks, your wires, your bank accounts, your reputation, and many other things that can be at risk from the external fraud. So I'd like to move into some of the stories and get some of the real experiences that Joe and Dave have with fraud. Dave, would you be able to share with us one of your more significant internal fraud stories?
Yes, I would. Trying to think back on different stories, probably one of the most significant ones would be a religious organization or a church, and this fraud involved a pastor from a rather large church, probably about 750 members, non-denominational, and it included mostly credit card fraud, also included offering cash theft, theft of supplies, and theft of food. The total fraud that was ultimately investigated and could be proved was about $750,000. There was also a lot of cash theft that we kind of knew about, but like a lot of frauds with cash, it's hard to prove the exact dollar amount.
Dave, I find that amazing. $750,000 from one organization, and this was a church. You think you can trust everyone within your organization, and certainly if anyone is trustworthy, I would think the pastor at a church. But this kind of opens my eyes a little bit to say that it can truly happen to anyone, and it could happen within my organization as well.
It's amazing because most of my investigations involve relatives, people that your most trustworthy employee. It's someone you don't expect, pastor, a brother, and that's why it's good to have controls in place to make sure that even an honest person doesn't make the wrong decisions.
Dave, I'm really curious when you tell the story, how was this fraud detected?
Like the majority of the investigations I do, this was uncovered by a whistleblower, and it happened to be the secretary of the pastor. So in most cases, we'll have a secretary or another employee will either bring it to the attention of a board, or they'll have a whistleblower hotline, something like that. But in this case, it was the secretary of the pastor.
So it sounds like employees need to really feel trust for leadership and someone that they can go to and have that avenue to report certain things.
Correct. It's got to be an anonymous way to identify someone. So, if your boss is doing credit card fraud or stealing money, if you go tell his boss, what's going to happen to you? It's got to be a safe way for the employee to be able to, express their feelings on the subject.
Okay. I'd like to know, Dave, were there any red flags or any things where someone could step back in hindsight and say, gosh, we should have known because?
Yeah, there are always red flags after the fact. But in this instance, some of the red flags that they should have looked at, for one thing, the pastor was there for approximately 5 years. And before the pastor came, the church was doing real well in the black. And then after the pastor came, the membership stayed the same. But the church started to lose money, was in the red each year. So that was a big thing. Why did that change? Someone should have been asking the questions. Another thing, and this happens in a lot of the fraud investigations I do, is people are living outside their means. This pastor was receiving a nominal pay for a pastor and taking trips around the country, as well as luxury items like new cars, motorcycle, truck. So not every time someone gets a new car, new motorcycle, or fly out of the country, they're committing fraud. A lot of people have a second job or inheritance, or and some of it's just not our business. But it's our business to ask the question, is he doing what he's supposed to be doing at work?
I think that's pretty tricky doing external audits. Sometimes you see things that don't make sense from an individual, or they may seem to have too much cash flow for their income level. But what you have to hope is that the organization's not giving them any opportunity to commit fraud. Correct.
Yeah. I mean, you don't want to look down at an employee because he's got a brand new, Beamer in the parking lot and he's, making $40,000. Who's to say his wife's not a doctor, et cetera. So, it's a very, fine line. But it's, it doesn't hurt to look into it.
Dave, can you tell us, does this case have any similarities to other frauds? I mean, are there common themes that you see that are present in this case that happens in a lot of your other fraud cases?
All of them really have the lack of internal controls. In this case, there was no controls around the collection and depositing of offering, no written procedures surrounding the purchasing of supplies and food. A lot of times when I go into a case, there's no written procedures, and it's real tough because I ask, well, what are they supposed to be doing? And they're like, well, they're supposed to be doing this, but does the employee know what they're supposed to be doing? Does the employee know that the credit card fraud or the credit card purchases should be this or this? So a lot of times there's a fraud, but it's really hard to prove in a court of law because we don't have the internal controls and procedures in place. In the case that we were just talking about, there was also no listing of inventory or fixed assets. And like I said before, lack of policies. So those are a couple things that are similar in various fraud investigations I've done.
So Dave, this is certainly a fascinating case, and $750,000 is an amazing number. But I'm curious, what was the rationale or motivation behind this?
For this pastor, I think, and it always begins in a certain way and ends in a different way. Obviously, they get a little bit more greedy usually, and that's how the fraud gets uncovered. But in this case, the justification for this pastor in the beginning were health concerns of ailing relatives, one in particular, college costs of relatives, and various needs of friends. So a lot of the stuff in the beginning really came across as real kind-hearted, and he felt like he was doing the right thing, and then it just got out of hand. And everyone always thinks, I'm going to pay it back. I'm going to, get back in the black here. But in most cases, that's not the case.
Okay, great. Thank you, Dave. So the internal fraud perspective is certainly fascinating, but I'm curious to hear from you now, Joe. What is one of the more significant external frauds that you've seen, and how did that impact the organization?
Sure, I've got an example to share with you. And contrary to Dave's examples that have some longevity, my examples tend to be effectively real time and very sudden. So the example I'll share first is a manufacturing organization that revenues of over $100 million. So a large scale, complex organization. And and typically when we get involved, someone on the client side notices something out of the ordinary. And in this case, we're going to talk a little bit more about electronic fraud or cybercrime. And when the controller of this organization logged into their banking system, they got a duplicate login error. Oftentimes, when you log in, if you get an error such as that, or a system is down once your credentials have been input, that's a red flag. And at that point, the person wasn't able to get access to their system, had another user try. That person was unable to get access to the system. So there was something happening, and it appeared to be a compromise. So when they contacted the bank had been looking into their system and noticed that someone was attempting to use the automated clearinghouse network to move funds out of the organization. So effectively, their systems had been compromised, they had been locked out, and the criminals had taken over the internal systems of the organization, attempting to move funds out of the organization's bank accounts.
Wow, as both a business and an individual, because I do online banking as well, that's very frightening that someone could just go in and take those funds directly from your account. What's the recourse an individual would have on that, individual or a business, and are they different?
It is. They are different. Consumers tend to be protected more under the Uniform Commercial Code than our businesses, but there are things that a business can do, and they need to act on a very timely basis to protect the organization. In this case, one transaction for $24,000 did leave the organization's bank accounts prior to them notifying us about that. And the bank certainly has the ability to try to reverse or retract that transaction. But in this case, it's interesting because the bank didn't have a liability, the receiving bank didn't have liability. It was really on the customer who didn't protect their internal systems, thereby facilitating this attack. So that one was a little more tricky than a typical fraud situation.
Wow, Joe, this sounds very different from Dave's example. As we said, that happened slowly over time, but this is rather instantaneous. So how did this happen?
That's a good question. And you can imagine once it's uncovered, things tend to go into a frenzy. We're trying to regain control of the accounts. We're trying to stop transactions from leaving the bank. But a little while after that, we start to do a little bit of investigation. And what we found here was that the client's computer was compromised. And typically, the way that happens is through a phishing email, which is basically a fictitious email that contains a link. When the user clicks that link, it downloads a virus, some malware on the computer. And in this case, one of those was clicked, innocent-looking UPS tracking email that anyone could have clicked. And that downloaded some software, and unfortunately in this case the client didn't have the right antivirus or spyware software on the computer. So while that was happening, the controller logged into his system, someone was monitoring that ID and password, and immediately once he got in, they logged him out, changed the passwords, and took over control of the computer.
Wow. So what can an organization do to prevent that?
There are a lot of things, and a lot of them seem really obvious. The first one is, if you receive an unsolicited email or something that looks legitimate but might be suspicious, it's best to not ever click any link in that email, not download an attachment. And if you receive something from the bank that looks legitimate, just log into the bank like you normally would without clicking any links in emails. Most people that are reaching out to you with emails that have any degree of sort of sensitivity to them are not going to put links. It's just a best practice these days. The other way that computers can become infected is to go to infected websites. A lot of times they look like legitimate websites, but they've been kind of spoofs of those websites where you might be redirected. And another way that these types of things can be transmitted are on thumb drives if you're sharing information from one computer to the next. So, in a process like this, there's certainly technology controls that can be put in place, but dual controls, if you're moving funds, having separate users enter information, validate information, and release funds is always a good activity. Also, monitoring bank accounts is really good. And with systems now being in real time, you can effectively do that very quickly and very easily. And one other thing, if there's a normal kind of repetitiveness to transactions, it's a good idea to put things like dollar limits on a payroll file. This way, if something does happen, at least you can manage the impact of that event.
Joe, I hear a lot about the cyber crimes and don't click on unknown links and things like that. But my first question is this becoming more common? And the second part to that, how much time does an organization then have in order to respond to this type of fraud and money being removed from their accounts?
Unfortunately, it is becoming a lot more common, and the fraudsters are becoming very creative in how they address and attack your computers. If you ever want, your internal systems probably have a lot of control that prevents this type of email and phishing attack from getting to you. But if you ever want to take a look, go into your spam mailbox on your email account and just don't click anything, but look at what's out there, and you'll see a lot of attempted attacks. In fact, I just received one in our office last week that was a funeral notice, very vague about someone passing away, and click this link so I can leave my comments, and I need to do it now because the service is tomorrow. It's just, it looked funny. You delete those types of things, but it is happening every day. And the second part of your question, it's immediate. Your systems are being compromised. Your funds are leaving the bank account. So typically, according to the UCC, you need to act within 24 or 48 hours to have any hope of retrieving those funds. ACH is an overnight transaction, so we have a little bit of room and a little bit of a window to get those back. But there's notifications that have to take place and protocols that have to be followed. Conversely, a wire is a real-time and final transaction. It is a lot more difficult to retrieve those transactions, and as a result, additional security measures need to be put in place for that type of financial transaction.
Well, I just want to ask the question. You said 24 to 48 hours. Are they business hours or regular hours? Like over a weekend, you could have your bank account be wiped out.
Right, they are regular hours.
Okay.
If something happens on a Friday afternoon, you need to be notified or to notify someone and take action immediately. There's a lot of the UCC defines these very, very clearly, but the interpretation often has some ambiguity, and it usually leads to a lot of negotiation and disagreement among all the parties involved in one of these transactions. So our best advice is to act very swiftly if you sense anything is wrong with the bank accounts.
Okay, great. Thanks, Joe. Well, this is a fascinating story on the cybercrime and certainly the risks that are out there. Dave, I know you're a certified information systems auditor. I'd be interested on your perspectives on all the things Joe has just shared and the huge risk that's out there.
Yeah, Joe had some great information. One of the biggest things organizations need to be make their employees aware of are the security concerns and training. You can have the best, Norton antivirus or McAfee or, any other antivirus, and there's 0-day attacks out there. So someone's going to be infected before that antivirus can be updated to stop it. So the awareness training is the biggest thing that you got to make sure. You could have an admin or the president of the company, click on that link, and then for one instance, we had another CPA firm. They got a zip file. They clicked on it, and it encrypted every file on their server. And in order to unencrypt it, they wanted $3 a file, and you're talking thousands of files. So security awareness training for the admin to the president of the company is very important, as well as knowing your systems. Do you allow zip files in your organization? Do you allow, you've got to know that information. You've got to know what the risks are, and then based on those risks, decide what your company's going to do.
It's amazing, that CPA firm example, one email, one click, thousands of dollars and thousands of files.
I mean, that in this instance, they went, they just upgraded their server, so their backups got infected, etc. They went back to their old server. So, they lost a week or two of information. Now, they were lucky because they had another server that they upgraded from. But it's a huge threat. I know here at McKonly Asbury, we don't allow zip files just for that reason. Now, we don't allow it, but we still have to tell our employees, hey, don't open zip files, because everyone in most organizations, now I know you can prevent it, but most organizations are going to allow you to open your Gmail account, your Yahoo account, and in there, if they click on the zip file or any other, file that is malware or whatnot, can affect your organization. So, you could have a security awareness training once a year, or you could have an email that goes out monthly. You just got to make people aware of what's going on. If that, an example that Joe gave about the funeral, if I got an email like that, I'd probably send something out in a weekly email saying, hey, this email is going out, just be aware. And I know the employees get tired of hearing that, but I don't want to be here on a Saturday trying to unencrypt thousands of files. That's just not a good thing.
I think whether it's dollar losses, time loss, reputational loss, these are huge risks, whether it's an internal fraud or an external fraud to any of our organizations. I'm curious, I know check fraud is a big issue, and that can certainly affect a lot of our organizations. Joe, what are the latest things going on with check fraud, and do you have an example around that?
Sure. Unfortunately, old-fashioned check fraud is not going away. In fact, it's growing, and we see attempted frauds basically on a weekly basis. The good news is most clients that we work with have protected their organizations. So, we'll see attempts on an account, and we get to happily notify a client that they are fully protected and they will experience no impact. But there was an occurrence fairly recently where a client noticed 5 checks had cleared on their account for $2,400. And really, we see these from the business's perspective, that somebody accessed their account number, created fictitious checks, or in some way altered existing checks and redirected those. But sometimes we fail to see the other side of it. There are always consumers on the other side, and typically these go back to a lottery scheme or something like that, where a consumer is going to be notified that they've won money or in some way the beneficiary of funds, and they're given a check. And those checks are drawn on our corporate client. So not only is the client experiencing fraud, but those letters and fake checks are going out to hundreds, if not thousands of people. So the scope of these things can be enormous. And the recent twist we've seen on this, many banks now are allowing you to deposit checks by taking a picture with your smartphone. And what these scammers are doing when they contact someone, instead of mailing them a check, they're talking them into giving up their banking credentials so that the scammer can take a picture of the check on their behalf and deposit it into their account while they're on the phone. So that really expedites the process for the scammer. Unfortunately, it speeds up the time that a consumer would have to really think through what's happening. Once they give up that information, things will happen very quickly. They'll receive the funds, then they'll typically move funds out of the account out to the scammer, but very shortly after that, within a day or two, they're going to realize that check was bad, and they are ultimately liable for any funds that were taken out of their accounts. So technology is really playing a role into speeding up this process and causing a lot of confusion for consumers.
Well, speed is certainly an issue there, but how does this can affect my personal bank account as well as a corporate account? Do we know, are more corporate accounts being attacked this way, or is this more of a personal issue?
It really hits both sides simultaneously. So in this example, the corporate account had 53 fraudulent checks targeted against it. Now, once the bank's been notified, they can do a lot of things to stop that fraud from taking place. So, if you think of the other side of that, 53 individuals deposited these checks, and quite often, when we get contacted, our primary responsibility is to protect our client and recover as much of those funds as possible. And there are return protocols between banks where the bank of deposit has to return those funds. But in some cases, we're literally making the decision: do we take the last $2,400 in that consumer's account and pull it back for our client? And really, that's our primary responsibility, and that's what we need to do. So if that consumer had checks outstanding or payments that were made using those funds, it will absolutely cause overdrafts, impact their credit, and usually it's an unpleasant conversation when their banker has to explain to them, they were the victim of fraud, and as a result, they're going to bear the full impact of that.
It's certainly where you see personal and corporate get intertwined, and certainly a lot of risk for any individual. Thank you, Joe. Okay, so I know we're about halfway through here, and I want to make sure we leave some time for questions. I see a few of them coming in, so I just want to take a moment and go back to Dave and ask Dave some questions about internal fraud. I've heard there are some cases out there where that involves lapping and maybe some tax collector entities. I saw some of this in the news a few years back. Dave, do you have any experience with that, and can you elaborate on that a little bit?
I do. I've examined a couple tax collector frauds, and one particular that I'm thinking about right now involves a 70-something-year-old woman. And what she would do was, the residents would send in their taxes, and then she would have to submit those then to the county, township, etc. And what she would do is the money would come in, and she would take the initial money. Say it was $1,000 check coming in. She'd keep the $1,000, and we'll say that is resident A. Then resident B would send in another check for, say, $1,500. Well, she would use $1,000 of the resident B's check to pay resident A's check to the county or township, etc. And it would go.
She'd pocket $1,000.
Exactly. So as long as she kept it current and the resident wouldn't get a late notice, no one would know anything. So, it just got larger and larger, and it's one of those schemes that you really have to be organized in order to pull it off.
So maybe your best employee. And someone
very
who's
well
very
be.
meticulous, very detail-oriented, that you praise as being so wonderful, would be very good at something like this.
Good with spreadsheets, correct. So this was part lapping scheme, and then the other part of this fraud was some of the taxing authorities didn't really have good reconciliations on their side. So if a tax collector was there long enough, they would, I think, gather that the reconciliations weren't quite being done. And as long as the tax collector submitted maybe 85-90%, no one would ever notice. It's just when they got greedy and it got more and more. So it was part that, and then part lapping scheme was this situation.
So you mentioned $1,000 number. I mean, this takes a lot to accumulate anything. What type of dollar fraud are you looking at?
Well, here we're talking about $250,000, and we're not talking about just individuals. We're talking about corporations that maybe have a $50,000 tax, so that could add up pretty quickly. And I know in one of my, it wasn't this one, but another tax collector fraud I had, I believe the check was close to $50,000, and the client got another notice for $50,000, and they paid both. So, even on the client side, organization's not always the best. So then, when we found this out, we go back to the client and they're like, oh, we paid you twice. So it's organizations on all sides needs to be good.
Thanks, Dave.
Dave, listening to you explain that story, it really sounds to me like that slippery slope. Once the person starts this fraud, they have to maintain it. It probably is a lot of work to keep all those accounts, current. But they really can't stop, and they can't, let anybody see what they're doing. So I would imagine that's a pretty difficult thing for the person committing the crime to stop doing.
Yeah, it's really a slippery slope. I mean, the employee can't go on vacation, really can't resign, really can't do anything. They're stuck there paying back the different individuals before they get, late notice, etc.
And I know in a banking environment for years, it would be anybody that has contact with a process such as this was mandated to take 2 weeks off. And that's typically to watch the trend and see if things change. But with a tax collector, I really don't see a lot of oversight in that process.
Correct. Yeah, usually, across Pennsylvania, tax collectors have, at least back then, and we're talking a couple of years ago, had little oversight, which allowed them to submit stuff a little late, and really little oversight was the downside there.
Dave, I know I mentioned I saw this in the press, and this was a couple years old. I'm assuming that they've corrected a lot of those loopholes, and this is not as common anymore.
Correct. That is correct. I mean, they're doing a lot more audits of the tax collectors, etc. Back then, it was sort of a free for all.
What I can't understand, though, is we've talked in all of these, there's always a rationale, whether it's external fraud, somebody just wants your money, or internal fraud. What was the rationale behind some of these tax collector cases?
Well, the rationale for the one I was talking about was really gambling money. And, the person did have a sick husband, but it really came down to gambling. And in a lapping scheme, you're really looking to pay it back. I mean, you don't start a lapping scheme and think you're going to get away with it, because you're always paying someone back, robbing Peter to pay Paul. So you're really thinking this gambling is going to pay off, and I'm going to pay this back, or, I'm going to get a big inheritance, or, something. But it usually doesn't end up well for anyone.
So thank you, Joe and Dave. These stories have been fascinating. But what I've noticed, someone who's not a fraud expert and pretty entry level, I'm always used to seeing the fraud triangle. And we've talked a lot today about rationalization that in many times starts with very good intentions, whether it's a sick relative or a college tuition, or maybe not so good intentions like a gambling addiction. And there's always some type of personal pressure that someone needs the money, wants the money. But as an organization and a business, or even an individual, we can't control rationalization or pressure. The one thing we can control is to limit the opportunity. So in all of these cases, there was an opportunity given. Somebody left a door open, for lack of a better term, or they left the window open, and they gave someone just a small enough opportunity to execute that fraud. So I think it would be helpful, Dave, if you could share with us the lessons learned and ways you can prevent some of these frauds.
I think most of my fraud investigations could have been prevented if there were policies and procedures in place, as well as controls, cameras, different just security measures. And a lot of times clients will come to me and say, we're a small business, we can't afford, that control or this control. And oftentimes I tell them, I say, it's the appearance of controls that is really going to help you in this situation, as opposed to, if you can't afford the control. And when I say that, a fake video camera in the corner of a room is going to do the same thing as if it's a real video camera. And then I have, a lot of honest clients come to me and say, well, that sounds really deceptive. And, I come back to them, and I don't think there's anything wrong with putting a fake video camera up, but, it's like a $14 thing instead of $1,000 item.
I think certainly the real one would be better, but there are alternatives if you are watching those dollars. But it's interesting when you say they can't afford it. I don't think they can afford the average $20,000 fraud.
That is true too. Yeah, it's very hard for clients to want to, do something ahead of the fraud, do an investigation of their controls, to see what issues they have. A lot of times I'll go in for an accounting project at a client, and I'll be like, you have these three. If I was going to steal money here, because I'm always thinking that way when I'm investigating, if I was going to, misappropriate your funds, this is how I would do it. And they're like, wow, that is, interesting. But no one wants to pay a $5,000 engagement to investigate that. It's funny because then 2 years down the road they have a $20,000 fraud, and again another it doubles, and we have to investigate. But I go back to the appearance of controls is the most important thing. If you can afford to put the actual video camera up, great. Otherwise, appearance and awareness. You want that employee to think that boss is doing everything completely legit. You don't want to give them the rationalization that it's okay in the organization, and you don't want to give them the opportunity. So.
Dave, that ties your comment about the camera made me chuckle, because I thought of a story we have actually that occurs reasonably frequently. One of the highest risk transactions a business can take is with cash, but often it's an afterthought. And banks have recently launched a product called a Smart Safe that for retailers, the employee can, instead of making deposits and having to take those funds to the bank or contract with an armored courier, this safe gets put in place and the employee feeds the bills in, it counts them, it makes sure they're not counterfeit, and then the bank handles the transportation of those funds. So it takes all the risk of an employee carrying a bag of cash every day off the table. But one of the features is banks require that a camera be put in place. And ironically, that's a big objection to people, that they have to install a camera to protect the asset that's most often the target of fraud.
Mm-hmm.
But as you said, what I see on my side, regardless of the type of fraud, communication, awareness, and training are really the key. The internal controls are great, and most times when a client says, I haven't been impacted by fraud, if you ask what they've done to prevent it, chances are it's not a lot. They've been lucky. So if you have the right internal controls, which highlights things like separation of duty, and that's difficult for a small organization, but the person writing the checks shouldn't be reconciling the account.
Mm-hmm.
And then a client might say, would I use positive pay? But the same person who issues the checks manages the exceptions. So, you're putting the keys to the kingdom, as you said before, in the hands of one person. It gets more important with more real-time transactions like wire transfers. The person who sets up the instructions shouldn't be the person that approves those instructions and initiates the transaction and ultimately releases it. You got to have multiple parties involved in that process. Even things on the internal side, like managing vendors, putting a new vendor through a screening process to make sure it's not a sole source vendor where an employee is sort of purchasing from themselves and defrauding the company. But the bottom line is, we'd like to see clients write less checks. That certainly is a good preventative measure. If you're writing checks, you need to protect them. There's different variations of an old service called positive pay that makes sure the dollar amount recipient of those checks doesn't change. And you need to monitor electronic transactions. One way to do that, there are tools out there. Everybody likes to be paid electronically, but you're giving up your banking information. There are tools available to mask that banking information so that your customers can get it to pay you, but the criminals can't get it to steal from you. And then internally, as we talked about on the cyber side, you really need to have the vigilance to manage and monitor your systems, but work with your IT folks to make sure that you have the right tools and preventative measures in place.
Those are some great ideas, Joe. Just a quick question. With that Smart Safe, do you find that mostly your cash-based customers like pizza shops, ice cream parlors, small clients like that would be interested in that?
Absolutely. Whatever the cost is, and typically, the cost, it's a piece of hardware, it's a safe, it's smart, it does things other than just protect your funds. But if you look at that cost relative to what the impact would be of a holdup of that employee or that employee running off with a day's deposits, it's really insignificant.
Now, we usually use the cameras in order to make sure that they're entering into the point of sale system the actual transaction. Now, would that Smart Safe actually interact with the point of sale system, or is it a separate component?
It's a separate component, but it dovetails in nicely. So the cameras in the POS are going to make sure funds from the transaction hit the drawer. The next process is to make sure the funds from that drawer hit the smart safe. So in a monitored environment, the funds never leave the office, and there is a control and a linking of those two steps that really doesn't take place if it's a more manual process.
Well, that sounds great. I mean, even in a bar setting, we've done a lot of bar investigations, and there's just cash flowing everywhere, and that just seems like a good answer at this present time.
Okay.
Well, Joe and Dave, this has been great. I certainly appreciate all the stories that you've shared with us. I appreciate all the things I've learned today. Some of the things that really resonated with me is, well, fraud does happen. Personal fraud, corporate fraud, internal fraud, external fraud. 61% of businesses were affected in 2012. And some of the dollar amounts are just astonishing. $500,000, $750,000, even the average fraud, $20,000. That has a huge impact. A few of the things that resonated with me as I was sitting here listening to both of the experts is that we really need documented processes and good oversight of those processes. I also heard you say that communication, awareness, and training are all very critical to preventing fraud. And the one other thing you said is segregation of duties. I always say that in my financial statement audits, my benefit plan audits. I don't think anyone can disagree that good segregation of duties will be helpful for any organization to prevent fraud. And the last thing we talked about, whether it's cameras, positive pay, lock boxes, whatever it is you may use, you should be looking at tools that can help your organization or even you personally to prevent fraud. So we certainly thank you for your time today, and we welcome any questions that you have. We have a few that are coming in, and we'll turn to those now. Great. We'll start with the first question that came in, and we did get quite a few questions, so we're going to answer them in order. And any that we don't get to, we will follow up with you personally. So the first question, I think either Dave or Joe can answer this. It was about the statistic that 61% of businesses have experienced attempted or actual fraud in 2002. The question was, does this rate apply to colleges, universities, and nonprofits? Want to start, Dave?
Sure. Talking from my experience in my investigations, I've found that actually nonprofits seem to have a higher percentage of fraud. And oftentimes the nonprofits I've worked for, although it may be a lower dollar amount, has more effect on the company than, say, the for-profit companies I've dealt with. It might be a larger fraud, but it doesn't have as much impact. So some of them are like fire companies, PTO, nonprofits that, the fraud may be $15,000, but that may be 20% of their total revenue. So I found that nonprofits may be hurt even a little bit more, at least from my experience around Central PA.
And Dave, I agree. On the financial loss side, that $20,300 number encompasses a broad variety of different types of businesses and industries, but relatively speaking, the loss is significantly more impactful to a nonprofit just by virtue of their size and the way the organization operates. So for the same reasons you identified, I think the same information is true on the financial loss as well.
Great, thank you. We're going to move on to the next question. This question involves liability, and it says, where does liability fall if a loss is incurred? I think we're pretty confident that on an internal fraud, it falls to the organization. So I'm going to turn this question to Joe so he can comment on external fraud.
Sure, Janice. It's an interesting question because for years, the bank of First Deposit was liable because they're the ones that took possession and negotiated what turned out to be a fraudulent item, and it was their responsibility to identify that as fraudulent. But with enhancements in technology and the sophistication of these schemes, that liability is changing. So Sometimes it's the bank of first deposit, sometimes it's the drawee bank, and sometimes it's the actual client whose account was compromised. It just depends on the circumstances, and some of it comes back to, was there negligence on any part? How was the fraud perpetrated? Was there an ability by anybody in this process to identify the item as being fraudulent? And if all those things come back that there's nothing anyone could have done, sometimes the liability can fall back on the company. So it really is case by case, and there are plenty of stories to validate sort of all different aspects of this. It's why we kind of advocate vigilance and prevention versus just kind of blaming each other at the end of the day.
Yeah, it sounds like those liability laws can be rather tricky, and you just want to make sure you're doing everything you can to protect yourself and your organization. Thank you, Joe. We'll move on to the next question. We actually have several questions involving positive pay. So I'm going to direct these to Joe. On the positive pay side, is positive pay enough protection? What other levels of protection might you recommend? And how has positive payee versus positive pay progressed over the last few years?
Yeah, that's an important question, because once the concept of shared liability took root, the next question is, what do you do to prevent the occurrence and limit your liability? And positive pay is one of many preventative measures. And as Dave suggested earlier, communication awareness, training, and the right internal controls are the first line of defense in any case. But when it comes to payment fraud, I'm looking at a little fraud diagnostic I have here, and there are about a dozen things, whether they're services or strategies that can be pursued. So positive pay is great, but typical positive pay using microline information validates the check number and dollar amount. It doesn't prohibit the payee from being altered. So it's your check with a different payee. Payee positive pay does that. And even beyond that, there's some other different variations. But again, that's just check. Then you get into, ACH, both credits you send out, as well as debits to your account, wire transfers, and a whole bunch of other aspects. So positive pay is great, but it really is the first line of defense, and there has to be some other things done in combination with that to truly protect your accounts.
Great. Thank you, Joe. I do know we're getting close to the end of our time. There are a few more questions. I'm not sure we have time to answer all of them. So I do want to give Dave and Joe the opportunity to give us any final words or any final thoughts that they have for our audience. I'll start with Dave.
Thank you, and thank you for listening. I guess the final thoughts I have is the cost of prevention is a fraction of what it's going to cost to detect and investigate the fraud. So I just urge everyone to make their employees aware, to be aware who your employees are, and just take those extra steps that may cost you a little bit in the short run, but it's going to save you a ton of money in the long run.
And Dave, I couldn't agree more. The right prevention does a lot of things, and specifically as it relates to bank services, a lot of people refer to things like positive pay as an insurance policy, but I'd go one further. It's actually an insurance policy that provides value to you every day. It expedites reconciliation of funds. It provides better information and insight into your accounts. So yes, it does prevent fraud, but it does enhance the efficiency of the office on every day. So these are things that everybody should be considering, given the current environment we live in.
Okay, great. Thank you very much. We are going to take one more question as we have just a few minutes. And I'm going to ask Joe this question. If you start paying vendors online, does that increase your exposure to potential fraud?
That's actually a really interesting question. And there's a couple of different ways to pay online. Paying online through a credit card can actually reduce some of the liability. And again, there's even different ways to do that. Typical sort of open-ended credit cards may carry some liability. There are others that are more of a closed-loop system where the account information, the credit card information, isn't transmitted electronically. It's on file on both sides. So it's a little bit complicated answer to that question. So in many ways, using a credit card can actually limit your liability, or at least limit the ability of someone to gain access to your information because it's done in more of a closed loop system. Paying online in terms of letting someone debit your account certainly can maybe not increase potential fraud, but at least increase access to your information. And there are tools to prevent that as well. Something called UPIC, Universal Payment Identification Code, is a masking system so that you can give people the ability to pay you electronically without giving up your bank account information. So highly advocate paying online, but you need to know your trading partner and your customer or vendor, and you need to use the right systems in place to do that. Okay.
Great. Thank you, Joe. That's about all the time we have for today. You do have my contact information. Again, Janice Snyder. You also have David Hammerberg's up there, as well as Joseph Krzyzwicki. And I thank them both for their time today. Please don't hesitate to reach out to any one of us if you have any questions. And have a great afternoon.
Thank you once again for joining us for this presentation produced by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thanks again and have a great day.